What's the use of having a Ferrari that has no brakes? Every time you take it out for a spin, you know you can drive fast, but you also know you could crash hard. The majority of traders are like this as they try to make money fast, but what they don't know is how much risk they're taking. Hello and welcome to this week's Australian Stock Market Report. I'm Dale Gillam, Chief Analyst at Wealth Within. Now this week I'll be sharing with you 7 tips to keep you safe so that you can trade just as you like, but knowing you can always apply the brakes at the right time. I'll also give you my views on the All Ordinaries Index, and then we'll get into this week's stocks of interest. First, hit that subscribe button and click the bell on the right so you keep up to date with our latest videos. Also remember to tune in to our live Australian stock market show every Tuesday, 7 to 8 p.m. Australian Eastern Time. The stock market is a minefield for uneducated traders who don't understand the risks of trading. If you are someone who believes that the stock market is risky and you worry about losing money, then you are like the many others who apply a hit and miss approach to their trading. This is like someone driving that Ferrari fast, as it's great while you're moving forward at a fast rate, but it's not until you need to stop fast do you realise the full benefit of having brakes that actually work. The reality is that many take on too much risk when trading the stock market, when they could be getting better returns by taking far less risk. The thinking that it is only others that get burnt and not me because I'm too smart generally only hits home after you've hit that brick wall. Safely navigating your way in the stock market is a challenge for many, but you can increase your odds of success with some simple rules. A trader without solid rules and a trading system is greatly increasing their trading risk, and consequently they will blow themselves up sooner rather than later. I recall a conversation a few years back with a middle-aged guy named John. He had a wife, a couple of young kids, and he had worked for years in a labouring job, which was taking its toll on his body. He had read online how much money could be made in the market, so he set up a trading account with an online broker and started trading. Now, everyone who makes their debut onto the market hopes this will occur when the market is rising rather than falling. And the good news for John was that he had caught a wave and was riding high as the market rose. History demonstrates time and time again, however, that most traders are totally unprepared for when conditions change. And there is nothing more certain than conditions in the market will change. As mentioned, most never believe that the worst could happen to them until after it's too late. After all, bad things happen to other people. John called into the office one afternoon after I'd sent out an email about the risks traders take in the market, which really rang true for him. He knew he needed some help, but admitting this to someone was one of the hardest things for him to do. His ego had taken a huge hit when the market pulled back swiftly, wiping out his bank account and more. The good news was that John knew it wasn't just the fact that the market had fallen away that was the problem. It was what he had failed to do. As I listened to him tell his story, I could hear the pain in his voice when he recalled the events of the past couple of years, and I really felt for him. I also knew that what he was sharing with me was all too familiar for me to hear. Basically the same story that I've heard hundreds of times with a different name. John had just made a bucket load of cash from the market in a very short period of time. And this was far more money than he'd ever made in a year from his full-time job. But he made a fatal mistake and it cost him dearly. Now I want to share with you what he did so you might learn from his mistake. John was making so much money that he decided that he could make a whole lot more money by taking on more risk by using leverage. So he geared up his positions to the maximum he could borrow as the market rose. Now he honestly believed, even though he had no real education, that he was a great trader. He also believed he had finally found his calling in life. So much so, he actually decided to quit his full-time job and trade for a living. Now, there's nothing wrong with wanting to exit your full-time job. In fact, many of my students achieve this and go on to achieve even bigger goals. However, let me say first and foremost that it must be done the right way and with a proper plan, not using a hit and miss approach like John. Experience and the right knowledge would have told him that this approach was flawed and very high risk. But John did not have either, and so he was living in a false reality. John truly believed that he wasn't a gambler, but the market soon showed him what he was actually doing, in fact, was gambling, and gambling in a big way. It also showed him he lacked the knowledge and experience required. When the market eventually pulled back, he lost hundreds of thousands of dollars. And before you ask, yes, I have spoken to many people who have lost that amount and much more before waking up to what they were actually doing. Now, to make it worse, John had only just recently moved into a new home, and not just any home. It cost him 4 times the value of the house they previously lived in on the labourer's wage. His house of cards came tumbling down, and his whole perspective changed in a very short period of time. Instead of exiting the market, John began to take on more risk by chasing his losses, and he lost even more. Now, to top it off, he and his wife were fighting. He was angry all of the time and started drinking. He couldn't pay the mortgage on his new home, and he'd uprooted his children from their school and their friends for this new life. His wife eventually left him and took the kids. But here's the kicker. A very simple thing such as risk management, along with proper buy and sell rules, would have saved John from his demise. The unfortunate reality is that most venture into the stock market without giving these strategies any thought. The good news is that John hadn't given up. He finally admitted to me that he had no real structure to his approach and needed a system that would allow him to apply more discipline in his trading so that he could gain more consistency and certainty. After a long conversation, John came to the realization that he'd made 3 fatal mistakes. Firstly, he failed to properly educate himself. YouTube, books, and free stuff on the internet did nothing really to prepare him for what he was doing. Secondly, he did not understand the risks of trading, particularly when it comes to leveraging and how to manage this. And thirdly, he failed to exit his full-time employment with a plan. Getting this right is not rocket science, but it is likely to be the difference between you living the dream and you experiencing the nightmare. And the path you choose is really up to you. You can either tiptoe through the minefield like John initially did, or you can learn how to avoid the mines altogether as he does now. Just think about it for a moment. If you are driving that Ferrari with no brakes towards a cliff, but you don't know where the cliff is, firstly, what are the risks you're taking, and what do you do when you finally see that cliff and it's all too late? So here are my 7 tips I teach traders that I know if you follow them will keep you safe and stop you driving off that cliff or stepping on that landmine. Number 1 is that your biggest risk when trading comes directly from your lack of knowledge, skill, and experience in the market. Dismiss this at your peril. Do not think that just because you've watched many YouTube videos that you are getting a good education. Anyone with a camera can stand somewhere in their house and pretend that they are an expert. There is a direct relationship between knowledge and risk. The more knowledge, the better you are able to manage risk. And the best way to minimize your risk is to educate yourself properly before you trade. You need to recognize that what you pay now to learn properly is much less than what the market will take from you if you don't gain a solid education now. Remember, the market will always be there, but you may not if you lack the knowledge and skill. Number 2 is know the risk you're taking at all times. This means that every time you trade, you work out exactly what you can lose if something goes wrong. Now, you can only do this if you use a stop loss. Investing without a stop loss is high risk. A stop loss allows you to decide upfront how much money you are willing to risk. It's not what you stand to make that's important, but what you do not lose. Number 3 is that trading without a proper plan is gambling. We all know the saying, fail to plan and you plan to fail. And I think Warren Buffett got it right when he said, someone's sitting in the shade today because someone planted a tree a long time ago. Most traders I've met do not have a plan, whilst some that do not really know how to create a proper trading plan. Make no mistake, this process is critical to you reducing your risk and increasing your success. Number 4 is never buy a stock just to get a dividend. Always buy for capital gains first and dividends second, as the dividend is the icing on the cake, not the cake itself. Number 5 is never take tips, no matter how tempting it is or who it's from. It is far better for you to set up a watch list with 10 to 20 stocks that you know like the back of your hand and develop your own strategies to trade them. Hoping that someone else's tip will perform rather than knowing yourself is gambling. Applying someone else's strategies will increase your trading risk. It's vital you learn how to pick the right stocks for you and have the right rules that you know how to manage. One of my favourite sayings is give a man a fish and he can eat for a day, teach a man to fish and he can eat for life. Number 6 is never buy a stock because it appears cheap, as you will get it wrong nearly every time. Cheap does not mean you'll get a bargain when it comes to the stock market. If a stock is falling in value, remember it can and most likely will get a lot cheaper. Always buy quality shares that you know are rising, as these are the most liquid stocks on the market and are more likely to continue to rise. Number 7 is do not over-diversify your portfolio. Whilst it's true that diversification reduces risk, a portfolio that is over-diversified, which is more than 12 stocks, will generally mirror the market. Now, I recommend that most traders hold between 8 to 12 stocks in their portfolio. The longer the time frame when trading, the higher the number you should hold. Short-term traders may prefer to choose between 5 and 8 positions. Now remember, there are only 2 things we can control when it comes to the stock market: when you buy and when you sell. Therefore, it is essential you understand how to get both right so you can adequately manage your risk in trading. It's not good enough knowing how to buy if you have no breaks to manage your risk. Knowing how and when to sell is critical to your long-term success as a trader, and we can teach you exactly how to do that. Now, let's review the market and this week's stocks of interest.
Please remember that this report is an educational tool, and as such, your personal circumstances have not been considered in the analysis of the compilation of shares included. The content of this report cannot be considered personal financial advice. If you have not done so before, pause the video and read the disclaimer on screen. We hope that you enjoy this week's report.
Alright guys, wasn't it an awesome week on the Australian stock market last week? I hope you've all had a great Easter and had a good time there. And whilst I was away, the market continued to play, I suppose, if that's why you want to talk about it. It has pushed right up to get into its highest level in a couple of years, actually. If we're looking right back on our charts, we can see that the market is very, very close to breaking the high that it had back last year, and it's about 6% from its all-time high back from 2007. Now, if you look on your screen, you've got a monthly chart of the All Ordinaries Index, and I've brought this up for a couple of reasons. One is we were due for a market pullback, and you can see that through here. We were due for that pullback, and that was part of the reason why I was suggesting late last year the market would fall into a low. Now, if I use my crosshairs and just click on here, you can see at the current level where we're at is very, very close to that all-time high, and we haven't been up at these highs since back there in January 2008 or back in December 2007. So we're talking about this is really, really good news for our Australian stock market. As you know, the US market has been making new all-time highs for quite a while. Our market hasn't been. It's been moving along, and I've got this long-term momentum, and I've just used the trendline tool, and what a lot of people don't look at is this big picture of the market. They tend to overuse daily charts, and that's actually the biggest sin that I find a lot of people coming to us. They just look at daily charts and they look at what's happening on a day. Like this stock went up today, it went down today, it fell at 10% today. And it really changes their psychology and their opinion about what the stock's going to do. And one day is completely irrelevant in the market or for a stock in that for that matter anyway. But looking at this, the market does tend to travel around that blue line that you can actually see. It keeps going around it and up and down around all of that. So right now it's moving away from it, and it will move up through and will break that high. Now if I just zoom it up a little bit so you can see here, it will break through that high in the not too distant future. If I go to my next chart, which is the one that I've been using a little bit more, you can see here, as I was talking about the other week, that close range between the opens and closes. Now we have moved through that now, and I'll just get rid of that. We moved up to a high of, what I can't see what that is, that's 6477.90, I believe. I haven't got my glasses on, but I believe that's where it's at. It's really close to that one here. It hasn't quite broken through that high from the 34th, that weekend in the 31st of August last year, but I believe it will do so this week and continue to move on. That gives us two different things. If we look at our previous all-time high, we're getting close. As I said, once we move through this, we're very, very close to that all-time high. That's pretty heavy resistance for our market, so I don't think it's going to break through that in the next month or so. I'm expecting our market to move up for maybe one more month, maybe towards the end of May, but come down towards June. And so we are getting another low probably around about June. It could be even into early July, but that's where I'm expecting it. So maybe a couple more weeks up, maybe a 1 week down and then a couple more weeks up. But sometime probably end of May, by the end of May, we would have had the peak, I would suggest, and then we'll move maybe down into June and possibly into July. So maybe 4 or 5 weeks coming down. Normal market stuff, not crashes. And I know, tomorrow night I'm going to be talking about stock market crashes and what goes on. So that's in our live show. So if you haven't seen our live show, Tuesday night, 7 to 8 p.m., I'm going to be talking about stock market crashes and why you don't really need to be worried about them from that point of view. But right now the market is looking good. Now let's go over to the stocks, and I'll just bring up the workbook for the stocks. And while I do that, I'll put on my glasses so I can actually read a couple of the comments here. We have a couple of comments, and I'm sorry guys, I was going to do a report last week, but I decided to go away. I got invited up to the Yarra River with some friends, and I was bike riding and having a little bit of fun, so I didn't do a report last week. So these are from the last week or so. I've got one from Bob. He says, is Cochlear looking cheap now? So Cochlear is on your screen right now, and I don't like using the word cheap in any stock because cheap implies that something's a bargain, and really having a cheap stock, if you've been watching my YouTube videos for a while and read my books, you know that cheap is a relative term. Cheap compared to what? And it's only compared to what the real value of this stock is. Right now, Cochlear has had, it's got its high there back in September last year at that 221. It's come down a little bit, but right now it's looking a bit bullish the last couple of weeks, but it remains to be seen to whether it can keep going up from this point of view. But it does look nice. This is one of the best stocks on the Australian market. If you have a long-term buy and hold view, then you put this stock in your portfolio. It's a great stock. It averages over 20% per annum over the last 10 to 20 years. So it's not one of those stocks that's going to lag behind. It's going to do very well in your portfolio. If you're a trader, then that's a different story again. If you're looking to trade this stock right now, there's no entry signal for me in it right now. And right now I need to assume it's going to be bearish. It's got more further falls at this point in time. So it's really about the intent that you have on this stock in terms of your portfolio and what you're looking for. Let's go to the next one. I've got one from William Jago. He's actually asked for lots of stocks over the last couple of months, but he says, could you please look at WKT? It isn't usually a share I would usually invest in as it's super volatile. So although it has such a large uptrend in progress, and I'm intrigued to jump on board. Do you think it would be wise to do so as long as I have a stop loss? So he's asking, should you jump on board as long as he has a stop loss? Now let's look at this. That's not a long-term uptrend at all. That is not even an uptrend in my book. Or it's large uptrend. It's large in price. So if I look at the chart here and I bring on my little price range percentage tool, you can see here from that low back there in December, it took off 284%. Currently, it's up around about 189%. This is a real speculative stock, so I understand why it's not normally in your portfolio. And when you look at that monthly chart, you can see how speculative it is. It's very volatile. It's had this huge basing pattern. And what people do with these sorts of stocks is they get caught in, they see some of these moves up. So let's look at this one through here. If I put my little tool on here, they see it hit this bottom. They see it go up 375%. Then they jump into it and then they turn a good trade into a buy and hold that now, so many years later, that's 2013, they're still in it because they go, oh, well, you know, if it gets back up to what it was around that 40 cents, then I'll actually exit that stock. Now, it got back up to that 40 cents. Now, looking at this, it's not looking super, super strong. Not a stock that I would trade at all, and it looks like it'll come back down here at this point in time. So not a stock that I would really want to look at here. And let's just put on the daily chart really quickly, and you can see how illiquid here it is. It's all these little dashes and everything else. Not a stock that anybody should be trading. And I had somebody on the phone, I think it was Friday, I actually came to work on Friday, and they said, oh, you always seem to, like these low cap stocks, you and Janine always seem to say not good things about them. And the reason why is trying to make money out of these stocks is fraught with danger. It's like gambling at a casino, and it really surprises me that people with the least amount of knowledge trade the most high risk volatile shares in hoping they're going to make money. But those with the most amount of knowledge trade the best shares on the market and make the most money. It's really inverse. And there's an old statement that when a man with money meets a man with experience, the man with the money gets the experience, and the man with the experience gets the money. And that's really apt in the stock market. So you do need to have the knowledge and experience there, but not a stock that I like at this point in time. The next one is an email from Joe. He said, hi Dale, I'm now watching your videos on a weekly basis. Welcome, Joe. Thanks very much for that. He said, I found your comments remind me to block out the noise of the share, opinions, media, forums, etc., and stick to my own fundamental rules before entering a position on any stock. That's fantastic to hear, Joe, because I think you should be doing that, or that's what everybody should be doing. If you're listening to lots of news and reports and a lot of market noise, you're going to make emotional decisions. Joe says, I'm currently watching PGH for a few reasons. One being they took a huge hit after they announced an early half-year result as required when price-sensitive news is known. Then when they released the actual result, which was identical to the early announcement a week later, it took another hit of a similar magnitude. Strange. Second reason, they've just hired Sanjay Dayal to take over. I think he's well suited to the company and industry with a solid history with Blue Scope Steel. Undervalued seem to be consolidating around 250, but I'm waiting until some uptrend movement before buying. Your thoughts? Let's go and have a look at PGH. So this is Pac Group Holdings Limited. Bearish, 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 bearish. That's all I can say straight out. Yeah, probably did take a bit of a jump here, but look at it. It looks terrible. Not a stock I would be in at the moment. Look at that. It's massively fallen since over here. Again, that's 2 years ago, 5th of May 2017. It's got a bit more volume coming through here from there. So it may have stopped falling, and this could be a bottoming pattern. But right now, if I just zoom that up, you can see a lot of indecision last week, opening on its low, pushing up, coming back down again. So I can understand what you're talking about in terms of the move that it's had. But right now, this stock does not look good. I'd be staying out of it, and I'd be waiting for some signs of that it's actually breathing and that it has actually stopped falling and is likely to move up again. So right now, I don't really like this stock at all. But keep it on your watch list, Joe, because it might turn out to be a good stock. But right now, it doesn't look like a stock that I would even trade. It's one of those interesting stocks. I'd need to put a bit of time onto this. The next one, next email we got was from Ben Mills. He said, hi Dale, really like your show and content. Thanks for that nice comment. Just wondering what your views are on A2 Milk and IFL or OFF Holdings, as I bought A2 Milk at around $4 and it reached its 52-week high again at $14.36. Do you think it's a buy, hold or sell? And what are your views on IOOF Holdings and buy and sell? I'm not going to cover IOOF because I'll just do A2 Milk. And really, don't worry about whether it's 52-week highs and lows are completely 100% irrelevant to me as a trader. I don't even look at them. Seriously, they're irrelevant to me because that doesn't tell me what the stock's actually doing. It just tells me it's its highest price in 52 weeks. As you can see, this is broken right above its all-time high. That was its previous one back in February last year. This is looking bullish. Stay with it. Simple as that. It's a good stock. It's moving up nicely. Do not expect it like a lot of people do when they look at stocks like this. They see this move from about here to here, and they see this massive 1,000% move between what was that June 2016 and February 2018. And I think it's going to do exactly the same thing again. It's not going to do the same thing again. Generally, those sorts of early moves, those big moves, they don't repeat themselves like that, because this company's getting more and more mature in the market it is, and there's more competitors coming out because there's opportunities in that market, and we're seeing that anyway. But it's still looking good. It's a great stock, so stay with it. That's it for me for all our comments for this week. If you want me to look at a stock for you, please comment below. Stick a little thing down there saying, hey Dale, have a look at this stock. Tell me whether you own it or you don't own it. Why are you looking at it? Because it's the process that you're taking that's far more important than the specific stock you're actually trying to pick. So please tell me a little bit more about what it is, whether you own it, whether you don't own it, why you're looking at it, etc., like some of these people have, because it really helps me to understand your thinking. Remember to get on tomorrow night show, 7 to 8 p.m. here on YouTube. If you want some questions answered on that, get on there as well. Post us some questions as well for there, or even send us an email through to info@wealthwithin.com.au. But to now, goodbye, good luck, and good trading.